Are you looking to shorten your mortgage term and save on interest? Understanding how extra payments work could be your ticket to financial freedom. In this video, we're going to discuss 2 ways on how to shorten your mortgage terms and decrease your total interest payments. Welcome to Money Funnel, your ultimate gateway to financial empowerment. Learn, get inspired, get motivated, because you deserve the good life. Now, let's start with the basics. In the world of mortgages, there's a process called amortization. It is essentially a fancy way of saying debt reduction. It happens as you make regular payments on your loan, which are split between the principal amount and the interest. Now here's where extra payments come into play. These payments are usually applied to the principal, which means you're reducing the amount of interest you'll pay over time. The exciting part is, even small additional payments can make a big difference. Imagine chipping away at a massive iceberg with a pickaxe. Every chip might seem small, but over time, it can significantly reduce the size of the iceberg. That's the power of making extra payments on your mortgage. Now let's dive into the process of making extra payments and see just how they can help you save on interest and shorten your mortgage term. Now that we understand what mortgage amortization is, let's explore how making extra payments can shorten your loan term and reduce the total interest you pay. Imagine you're paying off a 30-year mortgage. You're making regular payments, chipping away at the principal and interest. But what if you could shave years off your mortgage term and save on interest? That's where making extra payments comes in. Extra payments are directly applied to your principal, the original amount of your loan. By reducing the principal, you're also reducing the overall interest paid on the loan. Think of it as a snowball effect. The more you chip away at the principal, the smaller your interest becomes, allowing you to pay off your mortgage faster. Let's illustrate this with an example. Let's suppose you have a $200,000 30-year fixed-rate mortgage at an interest rate of 4%. With your regular monthly payments, you'll be paying $955 towards your mortgage principal and interest each month for the entire loan term, resulting in a total payment of $343,739, with $143,739 of that amount going towards interest. However, if you opt to pay an additional $100 towards your principal every month, you can reduce your loan term by more than 4.5 years and lower the total interest paid by over $26,500. What if you could squeeze out an extra $100 each month and increase your extra monthly payment to $200 towards the principal? Well, in this case, you can shorten your loan term by more than 8 years and decrease the total interest paid by more than $44,000. That's 8 years of mortgage payments you wouldn't have to make. Remember, these are just examples. The actual savings depend on your mortgage terms and the amount of extra payments you can make, but the principle remains the same. Extra payments, even small ones, can have a significant impact on the length of your loan term and the total interest paid. So, if you're in a position to do so, making extra payments can be a powerful strategy for paying off your mortgage sooner. It not only saves you money in the long run, but also brings you one step closer to owning your home outright. As you can see, those extra payments really do add up, helping you to pay off your mortgage sooner and save on interest. But what if you can't afford to make extra payments every month? Don't worry, there is another strategy that can help you pay off your mortgage sooner. One such strategy is making half monthly payments every 2 weeks instead of making one full monthly payment. It may sound a bit odd, but let's break it down. In a typical year, there are 26 fortnights, meaning 26 2-week periods. So if you're making half your mortgage payment every 2 weeks, you'll end up making 13 full payments over the course of a year, instead of the usual 12. That's like making one extra payment per year, without feeling the pinch of parting with a large sum at once. This strategy can have 2 major benefits. First, it can help to shorten your loan term. You're effectively paying off your mortgage faster because you're reducing the principal more quickly. The second benefit is that you'll pay less in interest over the life of the loan. Since interest is calculated based on the remaining principal, decreasing that principal more quickly means less interest accrues. So, even if you can't make extra payments every month, making half-monthly payments every 2 weeks can still get you to your goal sooner. In the same scenario mentioned above, if you opt for bi-weekly payments of $477.50, instead of a single monthly payment of $955, you can effectively reduce your total loan term by over 4 years and minimize the interest paid by more than $22,000. Make sure to first check with your lender if this is an option for your loan. So, let's recap what we've learned about shortening your mortgage term and saving on interest. Making extra payments on your mortgage can help you pay off your loan faster and with less interest. This process, known as mortgage amortization, is the reduction of debt through regular payments of principal and interest. Here's the exciting part. These extra payments can be applied to the principal, which reduces the interest paid. Even small additional principal payments can have a significant impact on both your loan term and the total interest paid. Now let's not forget about another nifty strategy, making half monthly payments every 2 weeks. This approach is equivalent to making one extra monthly payment a year. It's a simple yet effective way to chip away at that mortgage. Always bear in mind that every extra payment, no matter how small, contributes towards shortening your loan term and reducing the interest paid. Remember, every little bit helps when it comes to paying off your mortgage. With the right strategies, you can achieve financial freedom sooner than you think. To learn more financial tips, watch the next video recommended by YouTube here. Thanks for watching.